I have a serious question for you beginner traders out there. Are you guys ready to take your day trading to the next level? If so, stay tuned for the rest of this video. Hey guys, welcome to my channel. My name is Jonathan Falcon, and at this channel, we're going to be discussing a lot of topics based on day trading. Now, in particular, today we're going to be talking about the 5 components. And those 5 components are going to consist of structure, liquidity, imbalance, order block, and Fibonacci tool. Alright guys, so without further ado, we're going to go straight into the 5 components that are going to change your day trading game. Alright, first one, we have structure. Structure is important because structure is going to determine whether or not you're going to be buying or selling for that day, week, or month. Right here to our left, we have a picture perfect example of a bullish market. And one thing you want to note is bullish market consists of higher highs and higher lows. And also, your buying points of interest are going to be the current higher low in the market. But before you can identify your current higher low, you first have to see the market structure create a new higher high. Once it does that, then you identify your higher low, and then price comes down to that area, and then it starts to buy from that area. Now this is a higher high because it's higher than the previous high. This is a higher high because it's higher than the previous high. This is a higher low because it's higher than the previous low. And this is a higher low because it's higher than the previous low. Right here to our right, we have a bullish market picture perfect example. And one thing you want to note is that a bearish market consists of lower lows and lower highs being created in the market. Now your selling opportunities are going to be lower highs, but just like in the buying structure, right, in a bullish market, you first want to see the market structure create a new lower low, and then you identify your current lower high. And then when price retraces back up into that area, it'll then sell off, going back down to the current lower low in market structure. Now, moving forward, people ask me, how do you know when to stop buying and start selling? So right here, we're going to talk about the shift from bullish to bearish and bearish to bullish. Right here, we have a bullish to bearish example. We have a higher high, higher low, right? Higher high, higher low, higher high, higher low, higher high. If price were to continue going bullish, you would have to see this higher low get respected and then price buy above this current higher high in the market. But instead, in this example, price went from higher high, higher low, higher high to lower low, breaking this current structure, which now gives you the first sign that price is willing to shift from bullish to bearish. When price makes that lower low, you wait for it to establish that lower low, and then this retracement back up to the current lower high is going to be your selling point. And then from there, it should consistently make lower lows and lower highs moving forward. So right here to our right, we have a bearish to bullish example. Right, we have lower low, lower high, lower low, lower high, lower low, and then higher high. Price closes above this current lower high, breaking the structure, which is also your first tell that the market's going to shift from bearish to then bullish. As we see price close above that lower high, it then retraces to the current higher low in the market, and then it goes and respects that area, buys higher than this current higher high, making a new higher high, and then you identify this higher low, and then price will retrace back down to that area, respect it, and then continue to make new higher highs and higher lows. Now moving forward, we're going to be talking about how liquidity are targets, not entries. So as we can see in the structure, once price comes back to that higher low, it would then go and pursue that external liquidity. External liquidity is going to be found on higher highs, and then vice versa. In a bearish market, it's going to be found in lower lows. Now, one thing you want to note is that there's also internal liquidity, but I feel like that's going to be safe for another video. So right here, right, when price creates a new lower low, lower high, then a new lower low, it then retraces back into the current lower high, and then it sells down to this current lower low. Same thing all over again. Identify lower high, price retraces after making a new lower low and establishing, and then it respects that area and sells off to the current lower low in the market, as this is external liquidity. Alright, now moving forward, we have the Fibonacci tool. Now the Fibonacci tool is pretty nice because it shows you your premium discounted areas in your current trading range. Now this is something that you want to note that I didn't put on here. Okay, so you want to write down that whenever there's a new range, that means that price had broken below a current lower low or above a current higher high. Once that new lower low and new higher high is created, you then want to go from the like for this example, we have the lower high, the lower low, lower high, and then the new lower low. When this is broken, right, when price closes below this current lower high and makes a lower low and breaks below this current lower low and then establishes a new lower low, you then want to see price come back up into this area, right? Anything above 50% is going to be a premium discounted area. And then later down the road, I'll also show you these settings so that way you guys can use this Fibonacci tool as well. So once this range is created from this lower high to this new lower low, you take the Fibonacci tool, you measure it from the lower high to the lower low, and then you wait for price to get into those areas that are above the 50% equilibrium. What this does is it pretty much helps you minimize your risk and then also maximize your reward. And then right here to the right, we have a bullish market example, right? So there's a higher high, higher low, and then new higher high. Price closes above this current higher high, making it a new range. Then with the Fibonacci tool, you're going to measure it from the higher low to the higher high. And as you wait for that retracement back into the premium discounted level, that's below 50% equilibrium or 50% of that range, then as it comes into that area, you're going to look for signs that it's going to continue buying. And then from there, you pretty much just minimize your risk and maximize your reward. Once price exits these premium discounted levels, it'll then search all this external liquidity that's been built up. Moving forward, we have imbalances. Imbalances are pretty simple, right? They're created as the market impulsively moves in either or direction. Typically it's the same thing, right? When price makes a new higher high, higher low, and then a new higher high, there's always going to be a nice little footprint that's left in the market that price has to eventually come back to. And the reason why it has to come back to it is because in order for price to continue moving higher, it has to rebalance price action. Once price is rebalanced, then it'll continue giving you more signs of bullishness from this point moving forward. And then you'll be targeting higher liquidity targets that are up here, especially this current higher high, and vice versa. In this example right here, we have a lower low, lower high, and a new lower low. Once this is established, you want to anticipate and identify some imbalances that are within this range, because these are footprints that are left in the market that the market pretty much, you could say, market makers or AI softwares have to come back to in order to rebalance price action to then continue moving lower. So that's imbalances. And then last but not least, this is just identifying order blocks. Very simple. Kind of like with the basic structure we first started off with, we have a higher high, higher low, higher high, higher low, and a higher high, then higher low. Your higher lows, every single time there's a new higher high made, are going to be identified. Reason being is because these are the areas you're going to be looking to buy from, right? And it's going to continue doing the same thing consistently until price finally shifts, right? Until structure finally shifts from bullish to bearish. And then also right here on the right side, we have an example of a bearish market, right? Lower low, lower high, lower low, lower high, lower low, lower high. Each time in a bearish market, specifically, each time there's a lower low made, you want to identify the current lower high in that market structure. Once price retraces back into that lower high, it'll then expand and search for external liquidity, which is going to be your current lower low. So when it just continuously does that, right, until price shifts from bearish to bullish. Alright guys, that's going to be the end for today's video. If you guys enjoyed today's topic on the 5 components that can help you level up your day trading game, definitely leave a like, comment, and subscribe, as your support does mean a lot to the channel as we are starting to grow this small but beautiful day trading community. Also too, apply all the concepts that we talked about today, so that way you can continue to grow your equity curve and there could be a huge change in your day trading game. If you guys enjoyed today's video, again, do all the above and also turn on post notifications so that way you can be notified every single time I come out with more value. I'll see you guys in the next video. Peace.